Alternative investment funds are picking up pace in India. With tepid returns from both equity and real estate, HNIs are flocking to AIFs. But what should you be aware about before investing in alternative funds? I'm joined by Prateek Pant from Sanctum Wealth Management. Thanks, Prateek, very much for joining in today. Let me start by asking you that the AIF market has been picking up pace. How are you seeing the growth of this market in the past few years?
Thanks, Avni, for having me here. The alternate investment space has actually seen a fair bit of action over the last few years. So if you had to really divide it into two parts, you had the AIF regulations which came in 2012, and so there was this whole phase which was prior to that and subsequent to that. I think after the creation of the AIF framework, we've been able to position some sort of capital productively towards sectors which were not necessarily getting traditional sources of funding. So when you look at the broad framework right now of the category 1, 2 and 3 AIFs which are there, where category 1 is really investing more into the social venture capital space, where category 2 is in the private equity space which is there, and category 3 is more the hedge fund strategy. Initially, there were more the category 1 AIFs which had the infrastructure and the social venture space which saw pickup. But in the last 2 years, we have seen a lot of funds which are being raised both by category 2 and category 3 AIFs, and there is a substantial interest from the HNI community which is coming into this.
We've seen over 200 AIFs being registered by SEBI. In which areas are these largely?
Right. So I think of late, while the total commitment on the AIF is about 30,000 crores, a fair bit of it is actually coming into the category 2 and the category 3. And if one was to really break that up a little bit more, you are seeing a lot of investment today within the real estate space, on the private equity real estate space which is there. You are seeing a fair bit of new interest in the startup space which is there, and the third category AIF, which is the hedge fund. That's the other area where you've seen a lot more people coming in and wanting to offer those products.
We'll talk about all the categories you just mentioned, Prateek. Let's start with talking about real estate funds. What's your view?
Right. So the real estate fund space has really had this up, down, and now again up. And the reason why I say this is that if you were to look at funds which had been launched during the mid 2006, 2007 times, there was a lot of action in that area. You had a lot of money which was raised, but at that time it was more raised to buy land parcels in far off lands, and in general the investor expectations have not been met when those funds have been redeemed. So a lot of the funds have really struggled to pay capital. Some of them have not really achieved even half the desired returns which were there. But that space is really behind us because a lot of them have actually now run their course. Subsequently, people have become a lot more discerning in the type of investments which have been done in the real estate space. Over the last few years, you've had funds which are looking at high quality yield assets, and in a way are launching a REIT type of a structure within the real estate fund. There are people who are focused purely on equity, so they're buying assets with good quality promoters behind them. And finally, the other category which is really coming up of late is the distressed assets. So you have many projects on the real estate side which have been started, but the builders are now strapped with cash. So some of these funds actually go and invest in them, get a new developer, and that's seeing a lot of action of late. So in general, as I said, it started as a mixed bag, but now you are seeing a lot more defined mandates within the real estate space.
As a wealth manager, what's your recommendation on real estate funds, especially when you compare them to investing in direct real estate?
Right, Rav. So, last few years have really been the turn of the real estate cycle in a way, where people earlier thought of it as a one-way street, where investing in primary real estate, buying any new launches, and always the money is going to double in the next 5 years. That's not really the trend right now. You are seeing a lot of slowdown in general in the real estate sector. So if people were buying direct real estate right now, you clearly are seeing a pause on that. Having said that, there are still people who are interested in buying good quality commercial real estate assets, but that's more from a yield perspective. Now, the important thing to note when you're buying real estate fund versus buying real estate is that typically your commitment on buying a real estate asset, and if you want to buy good quality commercial real estate, you would be looking at buying at least a ticket size of anywhere between 15 to 20 crores. The real estate funds offer you a much better access and a lot more diversified pool. What I mean by that is, typically a fund would be investing in at least 8 to 10 quality commercial yield assets and has a lot more diversified portfolio, and you could actually enter into that type of an exposure with a ticket size of minimum 1 crore. So in a way, your bets are really hedged, and at the same time you have a professional manager who's able to manage this. Of course, if you have much larger pools to deploy, then you could still look at buying some of these quality real estate yield assets which are there. Secondly, even if you want to buy a diversified mix, so as I said, either you could buy pure equity real estate, that is a fund manager who's actually buying into under construction projects and wants to have the upside of what the price appreciation would be. There could be a fund manager who's looking at distressed assets, and then there is a fund manager who's really looking at buying this yield assets. So a mix of these type of portfolios, you could actually get exposure for a much smaller quantum versus trying to identify these type of assets on your own.
The other flavor of the season is startup funds. What's your assessment of such funds?
Right. So this is a space which is, of course, seeing a lot of attention right now. It is fairly well publicized, but you're also seeing the other side of it, where in general we know that 2 out of 10 ventures are really making it to Series A at this point of time. So you have very well-known people behind many of these startup funds, people who've raised money in the past, who've invested in quite a few successful ventures. They have they've got experience in the Valley, as in raising some of the mandates there, as well as they've dealt with companies in India. So it's a good mix, judicial mix of those type of investing background which some of the promoters come back with. It is an asset where you need to have that level of risk appetite. Unlike even if you look at the other two categories, you do expect most of your assets to give you some sort of return. Here, the diversified pool of assets will ensure that there could be 6 out of the 8 assets where you may not really get your capital back, but the other 2 could give you 30 or 40 times the return, and overall trying to generate anywhere between 15 to 20% IRR on the portfolio. So you need to be able to have that level of risk appetite when you enter into these startup funds on your own.
Finally, Prateek, the rest of the funds that come under the category 3 AIFs, which use a hedge fund like strategy to invest in, your view and recommendations?
Sure. Actually, the category 3 are probably the most interesting emerging category of AIFs. They truly are the funds which are expected to be uncorrelated to the broader market. So when we are looking at allocation from some of the HNIs, you would want to have some part of your portfolio which is not necessarily determined by what direction is the Sensex or the Nifty going to be, or how are the what type of returns is the debt fund going to give you. So they typically are the long short funds where overall they have a neutral position on the market. So they are taking positions on both sides of the market, whether they are going long on a certain strategy or a short position on a different view which is there. So it is an emerging category, and I think as awareness level on how the principle actually plays out, how are they able to deliver consistent returns and returns which have been uncorrelated to the broader markets, the appetite on this is going to grow quite significantly from the HNIs.
Let's talk about the performance of AIFs. You said real estate funds haven't really performed so well, but across categories, how has the performance been, especially compared to other traditional equity investments?
Sure, Avni. So I mean that's a very important point, because as again, when traditionally clients who came into the earlier real estate funds, they believed that they had an uncorrelated category where they had invested, and despite the markets having gone one way or the other, they should have actually made their returns in absolute terms. So as I said, some of the earlier real estate funds have really struggled in single digit returns right now. Having said that, as you're seeing that today, you are expecting most of the alternate, at least the category 2 funds delivering anywhere about 18 to 20% returns over the period of 5-7 years, while in the long short strategies, it is anywhere of 12 to 15% type of returns, where they are expected to deliver those type of absolute returns, again uncorrelated to where the markets are.
The other part, of course, is that the fees for AIFs are extremely high as well. From a real return perspective, how do they stack up against long-only regular mutual funds, for instance?
Right. So we've also seen a fair bit of evolution on many of these fees which have been there. The classic 220 structure, where 2% used to be the management fee, and after hitting a certain hurdle rates, the funds would charge 20% of all incremental profits which were or incremental returns which were there beyond the hurdle rate. That seems to be now getting a lot more rationalized. We're seeing funds which are ready to operate with a higher hurdle rate. So you are seeing hurdle rates of about 12%. So there is no profit sharing before 12% returns are really hit. The fixed fee continues to be at about 2%. So the expectation of the investor is that after fees and after taxation, you should still be making about 15% returns on these funds. So see, the important thing when you look at fees or returns in alternate asset classes is that these are they are finally a part of a larger portfolio. So it is allocating a certain capital into an asset class which is uncorrelated to your direct equities market. So it's not just fair to just compare that if returns from your broad market is 15%, if these are also giving 15%, is there any difference out there? Because the volatility on some of these funds, as well as some of the asset class exposure is substantially different and uncorrelated to the larger equity market.
All right, Prateek, we'll leave it there. Thank you so much for joining in.
Thank you.
All right, time for a short break. We'll come back and shift focus to real estate. Stay tuned.